Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have back the CEO, Richard Kellam, and the CFO, James Lorimer from Data Communications Management. Data Communications Management trades on the TSX exchange under the symbol DCM and on the OTC under DCMDF. The company is currently trading at $1.31 with roughly 44 million shares outstanding, or about a $57 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Data Communications, we spoke with you guys about a year ago. So clearly the last year has been another eventful one for everyone, but more specifically for you guys. Really good, at least last half I've noticed in terms of financials. So love to get, an update here, but before we do that, why don't we refresh everybody's memory and tell us what Data Communications is all about?
Yeah, so it's Richard here. So Data Communications has been around for 64 years. We're a company that specializes in marketing, communication, workflow, and physical printing, kind of the execution of that workflow as well. And we've been on a journey over the last couple of years to do more of that work in a digital format. So think of kind of digital workflow optimization. But we have a very healthy core business of, as I said, marketing, communication, and physical print that is allowing us to fund that journey or acceleration into digital. And maybe one other point, for everybody listening, is we've got an incredible client list. We work with 70 of the top 100 corporations in Canada. 255 enterprise clients represent sort of 93% of our revenue. There's not a single client that's more than 7% of revenue. So highly diversified account group through a multiple number of verticals: financial vertical, manufacturing, retail, energy, not-for-profit, healthcare. So we're pretty strong across a number of verticals. So it's kind of who we are and what we do. I can get into more detail if there's any other questions.
We'll save the questions for a little bit later, but you got a pitch deck or presentation deck that's up there. I'm going to let you guys have at it and just tell us what you want us to tell us.
Sounds good. All right. Well, James is going to take the lead. He's driving the deck. Given I'm just coming back from a client meeting. So go ahead, James.
Great. Thanks, Richard, and thanks, Paul and Trevor. Got a slide up here just showing a snapshot of who we are. As Richard mentioned, we work with some of the largest enterprises and government organizations across the country. We've got an extensive background in serving the complex needs, both online and offline communication needs for our clients. Trailing 12 months revenue, we're about $255 million. And we've seen some really strong growth in the past 6 months, which we'll talk about as we get through the deck here. We are nationwide, so we are kind of unique in our ability to serve our clients right across the country. And we have 5 big physical plants in Calgary, Drummondville, Quebec, and 3 in the GTA here in the Toronto area. We also have kind of a beachhead in the U.S. in Niles, Illinois, which is just outside of Chicago, and that allows us to serve the U.S. market. As Richard mentioned, some of the key verticals that we're involved in would be transportation, financial services, healthcare, retail, and a number of other markets. You can see from our kind of logos that we serve here, it's really probably one of the most blue chip client bases that you'll see, as you're looking at, kind of small cap companies. Most of our customer relationships are very long standing. Some of our relationships date back, more than 50 years. And certainly within our kind of top 10 client base, we've been working with those clients for more than 10 years, right across the spectrum. What's our strategic direction? really what we do at the end of the day is simplify workflow. And we've got kind of three buckets to our business: our complex conventional print business, which is really our kind of legacy print business, which generates very strong cash flow for us. As we've expanded to serve our customers' needs, we've really expanded across the marketing spectrum to provide technology-enabled marketing workflow. And so that's helping our clients not only with their kind of operational print needs, but also with their marketing needs, which helps them grow and better serve their own clients. We've been managing digital assets for our clients for over 20 years, and we see this kind of technology side as a great platform for our future growth, while our core business continues to fund our cash flow. One of our strategies is to really kind of continue to grow our business. We've seen some strong growth this year. If you look at our business, currently about 67% of our business is in that conventional print workflow world, and about 31% is what we call tech-enabled marketing workflow. And we've got a small sliver right now that's kind of tech-enabled services fees, where we charge our clients to use our platforms. We see over the next 5 years the opportunity to grow by kind of 5 to 10% revenue on a compound annual growth basis. And we see the profile of our business shifting. We don't see print declining. We actually think there's great opportunities for our print business to grow, but we see the shift in that business happening as we really kind of tech enable a lot of the other marketing workflows that aren't currently tech enabled. And so we see some great opportunities to do that, and that's going to help drive higher margins and also make us more sticky with our clients. Here are some of the 5-year financial objectives that I think we talked about a few months ago when we presented to the group here. We've expanded our revenue growth objectives based on our recent experience to 5 to 10%. We were previously looking at a kind of 5% growth range. We think we can grow our gross margins from the 30% range where they are today into the 35 to 40% range. That's a combination of making margin enhancement opportunities within our current product line, but also as we expand into some of our technology services, we think we can expand the gross margin on those products. SG&A, we've got a platform of kind of what we call zero overhead growth. And so as we grow our top line, we think we can control our overheads and our expenses. And if we do this right, we think we can grow our EBITDA margins from range currently of kind of 12 to 13 to 14% into the 18 to 25% range. And we've got some, continued plans to pay down debt. We've paid down a lot of debt over the past 2 years, and we think we're really positioned well for the future. How are we performing? We've got a bit of a snapshot here, but one of the themes we've been talking about for the last couple of quarters is momentum. And we really started to see some positive momentum in our business in the second half of 2021 as the COVID world started to really kind of become less of an impact on not only our business, but kind of globally. We've got a couple of charts here that we're going to build talking about our second quarter results, which we released just about a month ago, our year-to-date results, and then how we're tracking on a run rate. Revenue in the second quarter was up over 23% compared to a year ago. Year-to-date, our revenue is up almost 17% compared to a year ago. And our trailing 12 months, so we're kind of looking at our last 12 months through June, are up over 8%. The good news is this is also translating into higher gross profit margins, and you can see our gross profits actually growing faster than our revenue. So that's a good indication that we're getting some of these cost savings measures are being successful, while we're also growing margin with our product offerings. Net income, some of the numbers here are pretty big because we're coming off some low numbers, but definitely we're very pleased that we're actually showing really good, strong net income growth. And then EBITDA as well is really strong. And we're talking here kind of clean EBITDA. So historically, because we've had a lot of restructuring expenses in our business to optimize and right-size the business, we've talked a lot about adjusted EBITDA, kind of adding back some of the one-time charges we've taken. Our objective this year is to have clean EBITDA, and so far we're tracking really positively on that front.
I'll just add to that, James, that we've had zero restructuring year to date. We don't anticipate any restructuring this year and into next. We have a perfect footprint, right? We've done a lot of heavy lifting over the last, kind of 3 or 4 years, right-sizing the organization, getting the right supply chain footprint, and now it's about driving that and accelerating growth off that footprint. So and you're seeing that in the numbers. Okay, go ahead, James. Yeah.
Thanks, Rich. Here's just a summary of our kind of quarterly revenue last year in gray and in blue this year. And you can see on a kind of a quarter-over-quarter basis the improvements. We do expect to see continued improvements through the balance of this year on a revenue basis. And then likewise on a gross profit basis, you can see that our gross profit on a quarterly basis is certainly trending positively compared to last year. Year to date, it's up almost 18% compared to last year. And we expect these kind of positive trends to continue. Key to our kind of improved profitability over the past couple of years has been productivity enhancements. Back in 2018, we had over 1,400 employees. We've right-sized that, as Richard mentioned, to about 920 today. And you can see that our revenue per employee has grown nicely to about $275,000 right now. Our kind of near-term objective is to get that up to $300,000 per employee. So we've really leaned in hard to our productivity improvements over the past couple of years and think we're really well positioned. Here's a chart that shows EBITDA on a comparative basis compared to last year, and like revenue and gross profit, this is also trending positively. If we look at adjusted EBITDA, and this is kind of adding back restructuring expenses, we're also trending positively. I'll note here that 2021 did include about $4.5 million of wage subsidy in the first half of last year. So even if you back those out, or actually if you do back those out, we're even tracking a little bit more positively. So, we think, Q3 and Q4, good numbers to kind of continue to perform at this level. One of our key initiatives has been paying down our fixed term debt. Our term debt at the end of December was about $34 million. It's down to about $28 million. Our revolving credit facility has grown a bit since the end of the year, but this is really largely attributed to two key things. One is the revenue growth that we've experienced, and almost 20% revenue growth has required a little bit of working capital. We've also strategically built our inventory levels in order to have raw materials for our anticipated growth. And there's been a significant disruption in the supply chain for some of our raw materials. Think kind of paper shortages and freight challenges. We've been proactive in terms of making sure that we have the right raw materials so that we can supply our clients. On the new business wins side, maybe Richard, you'd like to talk a little bit about our business wins this year?
Yeah, we've sort of the point I said earlier, right? We've got the perfect footprint. We've got a great organization, right-sized organization, highly skilled, talented team. Now it's about driving growth. And we've got a lot of growth momentum in the business. Year to date, we've already booked about $22 million in new revenue that we'll see, through this year and into next, obviously as well, right? As we get that, continued revenue, and lots more, kind of planned in the second half of the year. So we've really leaned in hard to build a bigger and a better and a stronger growth muscle, and we're starting to get the results, or you're starting to deliver the results around that. And you can see the chart that it's across all verticals. So we're kind of winning new opportunities in healthcare, opportunities in finance, in the financial sector, in energy and manufacturing, and not-for-profit. So many new clients come into the business, and we see lots of opportunities for future growth as well.
Then outside of just our kind of our core business, but really important to our business is some of the ESG initiatives that we've been implementing. And maybe Richard, you'd like to talk about a couple of those?
Yeah, I think before I came in, we kind of, we had an ESG strategy, but it wasn't kind of well formed. We put a team together. When I say a team, it's a syndicated team. So people within the business that are responsible, in addition to the day job, to kind of lead our ESG strategy and execution of strategy. And we're kind of proud of some of the commitments we've made, and importantly, the delivery we're making against those commitments. Probably the one we're most proud of, we've made the most kind of a significant difference, is our reforestation commitment. So basically, for all of our paper use, we replant trees that would be, offsetting the paper that we use. So simple math: for every 83 pounds of paper used in our production, in our workflow for clients, we put one tree back in the ground. And I think year to date, as of last month, we're kind of north of 300,000 trees that we've replanted, and we do that on behalf of all of our clients. And the cool thing about it is many of our clients use it in their ESG metrics, because we have it audited right back to the amount of paper that each client uses. So therefore, how many trees that we're replanting on behalf of the client. So lots happening on ESG, lots of commitments around carbon and energy, et cetera. But it's probably the one we're most proud of. We made some a quick delivery around, is that reforestation commitment.
And, we've got a couple of concluding slides here in terms of, why invest in DCM. We believe we've got an attractive valuation at these levels. As Trevor mentioned, stocks trading about $1.31 right now. We've got about a $65 million kind of fully diluted market capitalization. Trailing revenues about $255 million. Trailing adjusted EBITDA is about $35.5 million. And last year we generated a little over $26 million in cash flow from operations. We don't have a lot of CapEx plans over the balance of the year. We're really using our cash flow primarily to pay down debt. And we are starting to invest in some of our technology applications and development. So you'll see a little bit of spend on that over the next year or two. But we really do believe that our kind of right sizing of the business is here, and we look forward to growing the business from the level that we're at right now. Talking about paying down debt, we'll pay down about $12.5 million this year of term debt, and then likewise we'll do kind of a similar amount next year in 2023. And our fixed term debt has a pretty good glide path here, so that by 2026, our principal payments on our term debt will be pretty much completed. We think we're well positioned for accelerating our business. We have kind of 3 C's that we talk about. We have very strong client base and strong commercial sales team, over 60 commercial reps across the country and in the US. We have some pretty unique capabilities in the market that none of our competitors have, particularly on the kind of technology side, and that really differentiates us in the marketplace. And then, we've got strong cash flow and high kind of free cash flow conversion rates on our business. From a capitalization perspective, sitting about a $65 million market cap right now. We do have a little bit of bank debt. We've got about, about $5 or $6 million in kind of options and warrants. Some of those are kind of in the money. Some are still a little bit out of the money, but at $1.30, actually, most of those are in the money now. Strong inside ownership, directors and officers and insiders are slightly more than 50% of the company. So we're definitely aligned with shareholders to create value here for the business. And with that, I'd like to thank everyone for their attention and pass back to Paul and Trevor.
Perfect. Thanks so much, James and Richard as well. So clearly you guys had a good sort of call it first half of the year. Revenues were up, a lot of metrics going in the right direction. What is the reason for that? What happened this, sort of the last 6 months to see the kind of revenue growth you guys are seeing?
Yeah, I'll take that. I'll take that, James. A few things. One is if you look at how we exited 2021, we exited, fairly strong, if you will. Like we moved from a negative up into a positive on the exit on the year. So we kind of exited with good momentum that carried us into the start of this year. And a lot of that was kind of refocusing the team on how to deliver accelerated growth in the business, and two things there. One is expansion revenue within existing clients, and then the whole new business development, like I mentioned earlier, really kind of focusing and targeting and working with that commercial team, post me joining the company. And that's obviously starting to, deliver results, and started delivering results specifically in the fourth quarter last year. So we had good momentum coming out of 21 and entering into 2022. Second is, the economy is other than some of the setbacks in the last couple of months, obviously the economy's pretty good, right? Post-COVID, a lot more consumers moving through the markets, kind of retail returning to normal, hospitality returning to normal, branches being open. So that obviously helps consumer movements, but obviously helps our business that is, kind of supporting those consumer movements. And then the third would be some pricing benefit. We've had significant raw material headwinds, and we've had to aggressively price against those headwinds. So if you look at our growth use quarter two as an example, we grew 23.4% in quarter two. Best way to look at that would be kind of a third of that would come from pricing, a third of that would come from a mix and expansion revenue within clients, and a third of that would come from kind of volume growth outside of existing clients. So hopefully that answers your question, but and that's why we're quite confident about continued growth over time. We've got some good kind of client momentum and growth momentum in the business right now.
Yeah, no, perfect. Okay, so you mentioned the pipeline, the 22 million in new business. You just mentioned about a third. It looks like a third of the revenue growth is coming from new clients or new business. Is there any one area that seems to be lower hanging fruit, that a sector or an industry that's doing better than others for you guys?
No, James, I think if we look across that new business we brought in, or even how we're expanding revenues with existing clients, we're doing it across multiple verticals. We've got great momentum in retail, good momentum in manufacturing and energy. We picked up some business in automotive recently. Our FI business continues to expand. We've actually picked up some new clients in not-for-profit. So it's kind of across all of our verticals. I don't think it's a single vertical, correct me if I'm wrong, James, where we're not seeing some positive momentum.
No, I think that's right. We're definitely seeing growth across our whole business.
Yeah.
Okay, fantastic. So you mentioned, the nice solid cash flow, debt repayment. Do you envision, at what point do you say, okay, we've paid down enough debt, we can allocate cash somewhere else? Or is this a multi-year process, do you think?
James, you're going to go ahead and answer that question.
Yeah, certainly our kind of near-term focus is continuing to pay down debt. And we saw kind of the aggressive schedule we have kind of this year and next. So that's our short-term priority. Definitely longer term, there's an opportunity to, look at other opportunities to use our capital, whether it might be, a share buyback or a dividend at some point down the road. And, we're also kind of strategically looking for acquisitions that might be a good kind of tuck in, either in our, to support our conventional print business. And those would have to be very strategic for us, or even some interesting little smaller technology companies that we've seen that, both public and private, that could be helpful in terms of accelerating our kind of workflow management technology platforms.
You guys did touch on the fact that sort of raw material prices are going up, and every day we're hearing about inflationary pressures. I mean, you guys are facing those challenges. You want to talk a little bit more about that, and any other challenges you guys are facing in this environment right now?
Sure.
Yeah.
Go ahead, Richard.
Maybe I'll just take on the first bit, then I'll turn it over to you, James. As I mentioned, the biggest challenge we face on our kind of core conventional business is just the access to raw materials. We've been pretty successful being able to price the inflation through, but historically, we get paper in the morning and put it on the press in the afternoon. Now we're having to buy it kind of 3 months in advance and bring it in from a multiple number of markets. We expect that that's going to correct, that supply chain is going to correct itself sometime kind of late 2023, but we're going to still have that dynamic in our business for the foreseeable future. And that, by far, that's kind of the biggest challenge. But you can see that, we obviously have got fantastic, procurement purchasing team, and we've managed to get, materials and the supply that we need to be able to keep pace with the growth. And you saw that certainly in our growth in Q1 and Q2, and we're expecting that to continue. So, but that would be the biggest challenge. And James, back to you for any others.
Yeah, no, I think the the kind of the fallout of that, and maybe the opportunity is that we're fortunate that we're probably the largest player in our broad market, in the Canadian market, and so that's given us some better access to raw materials than some of our smaller competitors might have. And so there's certainly an opportunity for us to kind of win market share in this environment. We haven't really seen, in terms of inflationary challenges, we haven't yet really seen our customers starting to pull back. So certainly that's a risk if the kind of broad inflationary world does start to kind of impact the Canadian market. But we're still seeing some pretty good strength from our client base.
That was going to be my next sort of follow-up question. Is just that, I mean, there's a lot of talk of potential recession, higher interest rates, things like that. What do you sort of watch that may keep you up at night in regards to sort of a slowdown in the economy? What's the canary in the coal mine for you guys?
Yeah, I'd say the big one would be to the extent that clients kind of pull back marketing budgets and marketing campaigns. Mm-hmm. If that's kind of a reaction to tighter markets. We certainly saw some dramatic pullbacks with COVID, but can't see an inflationary or recessionary type environment having anywhere near the impact that COVID did on the world. And so, we actually think we probably emerged from COVID, more nimble, stronger than we went in. So we think we're pretty well, prepared for that type of an environment.
Yeah, and I'd also let me add a little color to that as well, James. There's also equally opportunities that we see as well, and I'll give you a great example. Right, we're pretty strong in the FI space, and specifically around kind of private wealth, and assets under management are declining, obviously, just given the conditions of the markets. So some of the firms that we don't work with, and quite frankly, even some of the ones that we do, are having to reduce or find better ways to deploy their resources because they got less, their income is being compromised, right? So the budgets are being declined. So they're actually looking to move more into more of an outsourced model versus an in-source model. Many of them have people that do a lot of the work, and we just manage the execution of it. So there's lots of opportunities for us, to save companies money by actually outsourcing that workflow to us. So, so I just want to give a little color to, there may appear to be some headwinds, but equally there's some opportunities in those headwinds as well, especially in the FI space.
Yeah, no, fair enough. I agreed. You guys, roughly a $50 million market cap. You guys are, a micro cap, certainly in the Canadian space. And your numbers seem to be, position you as a pretty cheap, stock right now. What do you think the market or investors in general are getting wrong about the business that you'd like to sort of, clear up or correct?
Yeah, maybe I'll give him my answer and then I'll let James
Sure.
give you his. But look, DCM's a brand, and the thing about a brand is you've got to get noticed and you got to get remembered. And I think a lot of the memories that some of our investors, may have are historical memories. They kind of old DCM, not the new DCM. And now we've got to get noticed and remembered as the new DCM. And I think we'll see, the market kind of respond to the new DCM, and maybe they haven't fully responded because they still have that memory of the old DCM. So that'd be my input. And then James, can add some color to that.
Yeah, I would say, certainly over the past several years, kind of value stocks have not been in vogue. We seem to be seeing maybe a bit of a resurgence in value stocks. So hopefully that causes us to get noticed and remembered, as Richard says. And I think it's also we put up 2 or 3 good quarters of growth, and last year and a half we've been paying down debt. I think we just got to keep on the path we're on and keep doing what we're doing, and I think ultimately we will get noticed. So
yeah, I agreed. So looking forward then, what, as investors sort of watching you guys, what sort of catalysts or milestones or any sort of events do you think that we should be paying close attention to?
Yeah, so our third quarter results will be out November 8th after market. So that would be probably the next kind of near-term kind of formal catalyst, and then our year-end results will be published in towards the end of March. I think we typically don't have a lot of news in terms of big customer announcements, but as our technology kind of wins, as those start to accelerate, you might see some things there. I think what people might not have noticed in our second quarter results is growth in our subscription revenues and services, and that grew almost 100% compared to the prior years. So I think that'll be kind of a good indicator as to how that kind of transition from kind of print first to digital first is going. And as well, we have certainly had some pressures on margins, but we've been able to kind of sustain kind of in that 30% gross margin. And as we kind of get through some of these supply chain challenges, we see opportunities to continue to grow that gross margin. And so I think that'll be something to kind of watch out for from an investment perspective.
Richard, anything you want to add?
No, I would just add that just kind of echo what James said. Like, watch out for continued performance on our base business. Our base business is healthy, right? Super healthy, and you can see that growth, and you can see how we're investing to accelerate our growth. And as James said, as I said, right, a ton of opportunities for expansion revenue within existing clients, and then build out new business. And then look, we have got an incredible funnel of opportunities on the digital side of our business. We didn't talk much about that today because we kind of wanted to focus on the core. Hired a guy named Steve Livingston, who's 25 years experience selling software, and he's onboarded over the last 3 or 4 months and done a great job for us to start bringing more value to our existing clients. So watch that, and you'll see a lot more of that over time. We put a big number, or a good growth number rather, on the board on quarter 2. You see a lot more of that coming in, and then just consistency of performance, right? So those would be the catalysts as far as I see it, right?
Perfect. No,
and then maybe just one point on the margin side as well, right? Even with the raw material headwinds, you can see that we've been very successful kind of holding our margin. Not all of our competitors have, if you looked at some other public competitors. So we've been we've got some pricing power. We've managed to get our clients love us, and we managed to get that pricing through. We'd be in that range. We said 35 to 40 is our range. We'd be well into that range if we hadn't had these raw material inflation challenges. So eventually that's going to turn into a tailwind as well.
Yeah, no, I mean, good, solid performance from the business. It looks like you guys are dialing it in quite nicely, and great first half so far. Is there any other key message or anything you want to make sure that everybody leaves with today, or maybe something we missed, or just a key point that you want to make sure everybody really understands? Or did we cover everything?
I think you guys did a pretty good job covering everything, right? And, James, you have any key message to leave the listeners with?
No, I think, we're going to keep doing what we've been doing for the last couple of quarters. And, we look forward to kind of reporting back in November with our third quarter results.
Fantastic.
Yeah,
Go ahead, Richard.
Yeah, I mean, I just leave the listeners with this. Well, this is this market is a big market. Just the print market alone is north of a $9.5 billion market. The marketing technology solution market is a $135 billion market in North America. The marketing communication space is a multi-billion-dollar market in Canada. So there's a lot of opportunities here, and we're going to keep leaning into those opportunities. So.
Fantastic. Well, good timing here to catch you when we could. And thanks for joining us, Richard, from your car, James from the office. So we've been speaking with the CEO, Richard Kellam, CFO, James Lorimer from Data Communications. Again, the symbol is DCM on the TSX. Guys, thanks for joining us today, and we certainly look forward to catching up with you, hopefully after your Q3 report.